Hello, everyone. Good morning, good afternoon, good evening, wherever you are. My name is Hoda Mehr. I am founder and CEO of StockCard, and today's live stream is all about Pubmatic. It's part of my 100 bagger stock research series. I've been doing this for a while now, and the goal is to find those 100 bagger investment opportunities to add them to our portfolio. As a matter of fact, I always think if we can't aspire to find 100 bagger investment opportunities or investment opportunities that can increase, that can have return of at least 100 times, why do we even bother researching and picking stocks? We should be okay with investing in the indexes like S&P 500 and get the 7-ish percent historical return per year. And that's a really, really good investment return. But if we do take the time and want to research stocks or funds to find better investment opportunities, why not to aspire to find the best of the breed? And we call them 100 baggers in this stock research series. Okay, so without further ado, let's jump in and talk about Pubmatic. I want to tell you about first why even Pubmatic. So Pubmatic is an interesting company. I have a watch list on the stock card that searches for 100 bagger companies. It's a mathematical screener, and I'm going to actually switch my screen and show you that screener. It's a mathematical screener, here it is, that looks for companies that have some of the common characteristics of 100 bagger stocks in the past a decade or so, in the past century or so. So Pubmatic is very interesting because when we look at some of these basic criteria that typically goes with 100 bagger stocks, Pubmatic tends to always show up in this screener. And the reason I say it's always showing up in this screener is that this screener, or all the screeners on the stock card, refresh every night based on the information that is available in the stock market. So it's very interesting. You should be getting new companies fitting into the 100 bagger screener watch list. But one of the sort of cornerstone of this screener is always Pubmatic. And it's always, I'm doing this live as you can see, and you see Pubmatic is here. And I always actually think about whether there would be a day that Pubmatic won't fit into this screener. Nevertheless, it's still here. So that's why we picked this company to research it right now. The other thing we need to know about Pubmatic before we even jump into it is obviously we want to know what it does. But what's interesting about the company is that if you look at, let's go here to price chart, it's a recent IPO. I believe it went IPO in 2022, and it is down 37% from its IPO price. So IPO price of 27, now down to 17%. And if you look at its all-time high, it's something around 64%, down from its 52-week of 43%. And if you look at analysts' expectation or price forecast for this company, there's at least 41% upside in the company. So a lot of analysts, a lot of financial analysts out there believe there is a significant upside in the company. Although I would like the 41%, but I'm really looking at 100x, right? So we really want this stock to be 100 times bigger if we want to add it to our portfolio. So that's really where the company is at this point. And that's why we want to figure out whether it's worth looking at it as a possible 100 bagger or not. But before we even jump into the research, let's talk about what the company even does. So if you're not familiar with the company, with Pubmatic, let's read through its description. And so basically, it delivers superior revenue to publishers by being a sell-side platform of choice for agencies and advertisers. So I've read this before, and obviously their own description is a little bit convoluted, but what they really do is they use software to find the best advertising slots and match the best advertising slots with advertisers. on mobile apps, on CCTV, and generally on digital properties online. So it is part of those digital advertising trend, and it's part of that programmatic advertising space that we've talked about a few videos ago, I believe, when I had Simon Erickson on the show a few months ago. We did talk about this space. And what's very exciting about this space is that as a market, or as a core market, is expected to grow by 15% per year between 2022 and 2025. So definitely it's a fast and rapidly growing market. But yet again, we're looking for 100 baggers. So yes, the market is growing at 15% per year, but we really need a much bigger growth rate in the company in order for it to qualify as a 100 bagger. So how do we evaluate whether this company is a 100 bagger or not? If you're familiar with my 100 bagger research, you know that I use this seven-part framework that I borrowed from Chris Mehr. Chris Mehr is a fund manager and a very good investor, and he wrote a book called 100 Baggers, Stocks to Return 100 to 1 and How to Find Them. So this framework is based on Chris Mehr's framework, and I've been improving it over the course of months as I learned more about different ways of finding 100 bagger stocks. So as usual, we'll use this framework, the 7-point framework, to evaluate Pubmatic and understand whether it has the potential to become the next 100 bagger stock or not. So if you're ready, let's jump in. And if you're, by the way, watching live, please jump in whenever you can. And if you have thoughts, ideas, or comments that you want to share, please do. And if you're watching at a later time, again, make sure to put your comments in the comment section. I'll make sure to get you, have a conversation with you and get to those questions as soon as possible. All right, now it's time to research Pubmatic. The first part of this 7-part criteria is about the company's market cap. And you may already know, but in order for you to, it's basically a math, right? So if you are a $1 billion company, in order for you, it's a lot more feasible for you to become a 100 bagger company, meaning that increase in size 100 times if you are a $1 billion company versus if you are a $100 billion company. The reason is that it's just the laws of big numbers, right? When you have already a big market cap, it almost becomes difficult to assume that you can become a $100 trillion company, and that's what's needed in order for you to become a 100 bagger. So the smaller the company is, considering everything else equal, the higher possibility is for that company to become the next 100 bagger. For Pubmatic, I'm very excited about it because it basically is market cap. It's $740 million, so it's slightly less than $1 billion company, and that gives a thumbs up to this company. It does have the small market cap we look for a possible 100 bagger. So that's criteria number 1 from our 7-part framework. Criteria number 2 is, does the company have consistent revenue growth? And this was very interesting. As I was preparing for this live stream, I went to the company's financial strength section on a stock card, on its stock card, and what I learned was quite interesting. Let me actually make this screen a little bit bigger for you folks to follow me. So based on 6 different analysis, Pubmatic has a really good, solid revenue growth rate. And if you want to get the detail, it makes about $230 million in annual revenue. This is the last annual revenue. And on a quarterly basis, it's growing. On an annual basis, it's growing. It's always overperforming its peers, the companies that are in the same size and same industry as it is. And even on a 3-year history, the company, it's been growing quite rapidly. So this is a company with a solid revenue growth, and it meets the second criteria for the 100 bagger framework. Mind you that the company is supposed to, if you go to the key dates I believe the company is supposed to announce its next earnings earnings report on November 8th. And this is something to watch because we've seen digital advertising globally, it's going down, at least for this year because of the economic condition. So it's very possible that this next quarter, the earnings comes in and the company's revenue growth won't be as high as what we've seen in previous quarters, or it's not, it's basically even it's negative. But of course, we're not worried about it because when we talk about 100 bagger, we're talking about investments that we're gonna hold for a decade in our portfolio, even more than like 2 decades in our portfolio. So a blip in revenue won't be something that would worry us. But I did add a note for myself here for the earnings release next time that we're going to have earnings release on November 8th. This might be a case, right? So we're ready. If we see lower revenue growth, it's not going to bother us, as long as obviously the reasons are logical. So just be mindful of that if you're following the framework. So from a revenue point of view, the company meets the criteria for becoming the next 100 bagger. Number 3 on our framework is that does the company have a history of expanding its earnings power? In earnings power is a very interesting a metric because you could have a company that is not profitable, that's not profitable from a traditional sense of profitability, earnings per share, but it still has solid earnings power because as we know, earnings per share is dependent on obviously company's operations, but there's some accounting practices as well that goes into calculating what ends up being in the end of the bottom line for a company. Things like depreciation of their assets or, one-time expenses, one-time costs, things like that. So it was very interesting. When I started researching this company, I thought this is going to be one of those cases that we really need to dig in to figure out whether it does have a solid earnings power or not. But to my surprise, what happened is that I realized that this company is already profitable based on 22 different analyses on the stock card. It's solid profitable. And I'm going to scroll down to net profit. So it's not as big. It made about 56 million in annual net profit, net income in the last annual report. But what was very exciting is this solid growth rate, right? So quarter over quarter of net profit growth of 63%, year over year of more than 100%, 3 year of 191%. So this company is extremely profitable. It is profitable and has a history of consistent earnings power. So that was very exciting to see. You typically don't see from a $700 million company to be growing rapidly and be profitable as well. So this is quite interesting from Pubmatic. The other way that I typically use, or the other metric that it would be interesting to use for evaluating companies' earnings power is to look at its management effectiveness and look at metrics like ROE, return on equity, return that the company has created for every dollar of equity in its balance sheet. So equities are the stuff that the company used to invest and grow, and the return per dollar of that is quite important. Companies like MasterCard is one example that we looked at. It have been able to consistently grow the return on equity, and that's a very, very good sign of a possible 100 bagger. So if I scroll down to the ROE section of Pubmatic, we see it's not as exciting as this profitability that we were just looking at. 2 fiscal years ago, it was about just like really nothing. In the last fiscal year, it was about 11%. It's not bad, obviously. It's better than its peers. Peers are really down the negative. But what we want to see is a solid quarterly and annual return on equity. So put it together again. I don't think it's a bad return on equity, but as you see, there's like periods of blips in 2 fiscal quarters ago that it had lower return on equity. Mind you, the company only went public, as we saw, at the beginning in 2020. So we don't have even like enough history to evaluate the company's return on equity, consistency of its return on equity. So be mindful again. That's another thing we need to be careful about. Yes, it is profitable. Yes, it generates, sounds like it generates consistent and positive return on equity, but it just doesn't have enough history for us to gives us the thumbs up and say in the past decade it's been increasing its return on equity for its shareholders. So that's another thing to be mindful. We're going to get to the fourth characteristics of 100 baggers. Does it generate free cash flow to reinvest? And free cash flow is one of those things we always talk about it, and we've heard investors like Warren Buffett say he doesn't really care about profitability, but he really wants to see the companies to generate free cash flow. And that's because free cash flow is really the money that is left at the bottom of the company's, in the bank at the end of each year in order to take that money and reinvest in the business. And why it's so critical is that if you found a business model that even if it's not profitable, but it generates free cash flow for you, it can take that free cash flow and reinvest in the business and doesn't need to go and raise additional capital or borrow, right? Raise additional capital would dilute investors because you have to issue new shares to give it to new investors. And then if you borrow, obviously borrowing, it's not as bad, but if you borrow extensively, and then your balance sheet has that risk. It reduces your company's strengths when it comes to periods of difficult financial situations. So you really want to see a company that have found a business model that can generate free cash flow. And when it comes to Pubmatic, yet again, we see based on 5 different analysis, it seems to be having a strong and a growing free cash flow. Of course, when I look at this summary of free cash flow here, I see one bad and one neutral. So that gives me a question mark. What's going on? And I want to dig deep into it. And what is really happening right now is that the free cash flow on an annual basis hasn't been really consistent. So 3 fiscal years ago, it was about 20 million, went down to negative free cash flow. And then now it's another 49 million. It would be very interesting to see what's going to happen on November 7th, which the earnings with the next earnings report is. But that's the question mark, right? Both from a actual dollar value on an annual basis and on terms of a free cash flow growth rate on quarterly, year-over-year, or 3-year, we see some inconsistency, right? And that's a little bit of a concern. It is possible that this is the result of acquisition. The company used this cash to acquire some other companies, so that would be okay. But you do want to see that consistency over the 5 years, 10 years, 20 years of investing and holding that company in your portfolio. So if I want to go back to our framework and talk about its free cash flow, I'd say it's a question mark. It is positive. We've seen some solid results from a free cash flow point of view. We're here on number 4, but it doesn't, it's a question mark. It's a concern area. We're looking for that consistency. Number 5, there's only 3 more criteria left to evaluate whether Pubmatic is a next 100 bagger or not. So number 5 is about current valuation. So obviously, as long-term investors, we don't really care that much about valuation. We don't want to pay exuberant amount of prices for companies that we're holding. And so if we find an opportunity to buy the companies that we're investing at a lower multiple, it's creme de la creme, right? It's the best opportunity. It's the best time to buy that company. So when it comes to Pubmatic, it looks like it's fairly priced. There's not overvalued, but it's not undervalued either. But I really want to dig deep into it and see why does it say it's fairly priced. And it looks like there's 3 different good metrics for valuation and a few neutral and bad and some unclear status. So we did see company is profitable, and that's why it does have a PE ratio, which is great. Yay, right? Usually in the companies of this size, that growth rate of Pubmatic, we don't really see any profitability. So it's good to see a PE ratio, and it's 18x. So I believe S&P 500 PE ratio at this point is about 20x. So we do, from a PE point of view, we can buy Pubmatic at a lower valuation. That's great, right? That's one good sign. Let's look at its price to sales ratio. It's about 6x. So that's not exuberantly expensive, but what it means is that investors are pricing at least 6 times growth in the company's sales in the current price. So investors do have high expectations from the company. Obviously, we do want to see this revenue growth to be 100x bigger or 50x bigger, but that's something to be mindful of. With some metrics like price to sales, it's not as expensive as we want, as cheap as we want, and for some other metrics like PE, it's not as expensive as we want. So it's truly fairly priced as a balance, like as an average of these two different criteria. So I wouldn't give it a full thumbs up. It is still questionable from can we buy this company at a good valuation or not? But it's not as bad of a valuation as we thought. So I have 2 more criteria to go through in order to evaluate Pubmatic's fitness, I guess, for being a part of our 100-bagger portfolio. But if you may, give me 30 seconds to talk about a stock card. So as you know, our stock card, we give investors like you and I digestible insights to help us invest better. And we have big ambitions for the future of retail investing. That's why we've partnered with one of the leading startup investing platforms called Republic, and have now an opportunity for a community to invest in a stock card. So if you are a stock card user and believe in what we do, I really encourage you to go to republic.com/stock card and consider becoming an investor in the company too. We believe we're building the next 100-bagger fintech story and fintech company for our users, for our communities. So really want you to be part of it. And if you're not a stock card user yet, please join the stock card. It's free to create an account, stockcard.io. And then once you do that, also consider investing in our company and become a stakeholder and become part of our 100-bagger story. So once again, republic.com/stock card, and we hope to see you there. All right, enough of that. Let's get back to Pubmatic. Today, we're looking at this 7-part framework that it helps us evaluate whether Pubmatic is a 100-bagger stock that we would want to hold in our portfolio. We looked at top 5, and we're now down to the last 2 criteria. The next criteria we want to look at is whether the company have a skilled leadership team in place, and specifically whether the company has its founders, its original founders in place. And why that's important is that founders of companies tend to have really strong skin in the game. For example, I own the majority of a stock card. So if a stock card becomes the next 100-bagger company, I have all the incentives in the world to make a stock card successful, because that's better for me. And so you do really want to see that in companies that you're investing. You want to see the original founders with significant skin in the game, because their bottom line and their personal incentives is aligned with your incentives and you as an investor or what you're looking for. So typically, if you don't know where to get that kind of information, if you go to the company's investor relation website, you can get it by Googling it, or you can get it from a stock card by clicking the investor relationship section. And in all these companies, there's a section for governance. Let me make this a little bit bigger, zoom it a little bit. So all companies' investor relationship website, there's a section for governance. And in governance, you could see the company's board of director, you could see the company's leadership team. So here you could see management team for Pubmatic. And what I was very encouraged to see is that the original co-founder is a chief executive officer. The original founder is a chief innovation officer and chairman of the company. And the other co-founder, it's now president and head of engineering. That's really, really good sign. It seems to be that the original founding team are still in place with a skin in the game, but on all the incentives in the world to work for the shareholders like you and I. And so that's this one. And then we are down to the last criteria to evaluate whether Pubmatic is a 100-bagger stock or not. This last one is that, does it have a competitive advantage or moat? So competitive advantage, folks, it's a difficult one to evaluate because it's very subjective. It could be the brand, right? Something like Coca-Cola has competitive advantage because its brand is so strong. It could be cost, it could be network effect, it could be stickiness of staying with the company. So you need to really get to know the company's product and services to evaluate its competitive advantage. But there are ways to look at the company's operations and see the mathematical results of competitive advantage in a company's operation. Typically, a company with high growth, really high gross margin means that have found a way to serve its customer at a really, really low cost. So when you look at as companies, Pubmatic's financial strengths, and we go to the margins, we can basically see that Pubmatic has almost 70% gross margin, which is a really, really good figure. I believe something like Facebook has like an 80% margin. Some of the best 100-bagger companies in the last decade or last 50 years ago have really solid gross margins like that. On an annual basis, it has 74% gross margin, and basically it's overperforming its gross margin compared to its peers. So it's all really, really good signs. It means that Pubmatic business model is really low cost. And I'm not very surprised because if you read through the company's annual reports and about their product, what they do is they use AI, machine learning, to improve the efficiency of their system and increase return on investment for the ad dollars that are spent by their customers on their platform. And when you use tech software or machine learning and things like that, you basically have automated majority of the process and have improved the efficiency of it. So that means that your model, your business model, is quite low cost. One thing I have concern about when it comes to Pubmatic and its competitive advantage is just the small, right? We know there's bigger players, bigger fish in this pond. This sort of like programmatic advertising is a division of Alphabet, right? Rest assured that all big players in the digital advertising space are working on something similar. So we do want to be careful of that. It doesn't really get the sort of the big thumbs up from a competitive advantage, just because it's still yet to establish those moat and those competitive advantage. So here's the summary. What we've learned about Pubmatic: it is small enough from a market cap. It has consistent revenue growth. It has consistent earning power, or is shown it has a consistent and growing earnings power. It does generate free cash flow, but it has some blips in its free cash flow that we need to be careful about it. We do have a chance to buy the company at a fair price, but it's not exuberantly cheap. So that's not the best, but it's not also the worst. We did see the original co-founding team is in place, so that's really good. And then the last one is from a competitive advantage, uses AI, has really high gross margin, but it's something we need to watch for, because we can easily see other competitors to enter this space and eat the proverbial cake of Pubmatic. So all in all, it sounds to be a really, really good company. I wanted to make the final decision whether to add Pubmatic to my portfolio or not, for my 100-bagger portfolio or not. So recently I've learned about what is known as Rule 200. Rule 200 is a rule that is used by venture capitalists in software industry to evaluate whether a company is really good, has really good growth potential in the future. And Rule 200 basically takes 12 months revenue retention, 12 months revenue retention, revenue growth rate, gross profit, and operating margin of a company, combine all of that together. And if it gets a value above 200, historically has shown companies that have a value of 200 and above for these combined value of these four metrics have been very good investments. The only thing, I think revenue growth is very clear, gross margin very clear, operating margin very clear. We actually looked at it a few seconds ago together. The only one that I want to talk about is months 12 retention. And months 12 retention is basically calculation of return of the revenue of the customers who joined, let's say 12 months ago. So you take their existing revenue and divide it by the revenue they generated 12 months ago, the same customers. And then you calculate the growth rate. So that's counted, that's called retention rate. And Pubmatic has a really good high revenue retention rate, about 130% in last fiscal year, revenue growth of 27%, gross margin of 74%. These are all annual figures, and operating margin of 26%. All combined together, we have 257% above 200, and it gives a big double, thumbs up to Pubmatic as that good potential investment opportunity, even from a venture capitalist point of view. So with that, I want to welcome Pubmatic as the first company that we added to my 100-bagger portfolio. And I did add this last night and put a little bit of reason for it. So it looks like Pubmatic is a really, really good company, and it has found its way to our 100-bagger portfolio. So yay to Pubmatic. And the only areas of concern that I would want to personally watch for when it comes to Pubmatic in its next quarterly earnings, or in the few quarter earnings to come, is those things that we talked about. There might be that we see lower growth revenue growth in the next quarterly earnings or a few quarterly earnings due to the reduction of advertising dollars spent globally due to the economic condition. So that's expected, but we do want to watch that. We do want to watch the company's competitive advantage over things like the Trade Desk, divisions of Alphabet, all other competitors. And there's a personal note for me. I did try to understand the company's actual product. I know sort of conceptually what they do, but I really want, as a holder and as a stakeholder in this company, I really want to understand that detail. What is this company all about and what does it do? So that's about it. That's our evaluation of Pubmatic. I hope you really enjoyed it. If you're live, if you have any comments or questions, let me see if there is any comments from you folks. Please jump in, add your comments, and let me know. And otherwise, if you're watching at a later time, please add your comments in the comment section. Don't forget to check stock card investment opportunity on republic.com/stock card. We hope you join us as an investor, also as a user. Thank you for spending the last 30 minutes with me. I'll see you in the next live stream. Have a great rest of the day, guys. Bye.